Here we go. Dan Patton, mortgage
Yes.
broker extraordinaire.
Mortgage broker.
Yeah.
I don't know about extraordinaire.
So interest rates went up again yesterday
They did.
on October
26.
26.
Mhm.
So went up 50 basis points.
Mhm.
So where do rates sit as of today, which is the 27th of October?
So prime rate today sits at, are you ready for it? 5.95%.
Okay.
So up 50 basis points from 5.45%.
Okay.
And earlier this year, I think prime was sitting at 2.95%. So it just goes to show how quickly interest rates have gone up for those that are on variable rates or have HELOCs with balances, any sort of variable rate where the payment is affected by prime rate.
Okay. So variable, you're seeing them actually come in around 5.95 or it's
Well, depending on the type of product, the discount on variable, that's when you take a variable rate, most people understand that you have a discount to variable. So say prime minus 50, prime minus 60. So if prime today is 5.95 and you have prime minus 60, you're getting 5.35%. But the discount is disappearing right now. So yeah, I mean, you're seeing like on rentals sometimes prime, so right at prime, maybe on an owner occupied, you're going to get prime minus still, prime minus 30, maybe prime minus 40 on an insured deal. But yeah, I mean, we used to, it wasn't that long ago.
why is the discount disappearing?
Bond yields. I mean, the, prime rate is affected by the Bank of Canada, but the discount to prime rate is more the bond yields. When the yields are down, the rate is, the increase is higher. But that's the bond yields. That's why fixed rates are going up too. Same thing. The bond yields are up.
Okay. So where are fixed rates sitting right now?
Around the same. If you're taking a 1 year, 2 year, 5 year fixed rate, you're somewhere around 6%. Maybe a little under, maybe a little over, depending on the term, but somewhere around 6%. So we're sort of at a point now which is an odd time, it's happened before, but we're at a time now where variable is almost equal to fixed rates. And that's an interesting time because one of the things we really like about variable rate is that it's typically lower than fixed rates. So, not many people are brave enough to take a rate that might change when you can lock into a rate that's lower than the other rate. Right. So it's a lot of people get locked into fixed rates right now, which isn't a bad decision. I might caution against going longer term, 3, 4, 5 years, you might want to be careful of. But yeah, it's interesting time.
If you're going with a fixed rate, do you have that flexibility for the most case where you can choose a 1 year term or a 3 year term,
Yep.
a 5 year term?
Yeah, most institutional lenders will have like a 1, 2, 3, 4, 5 year fix. They go all the way up to, believe it or not, 25 years. Nobody buys them though. The most common was a 5 year fix. That was the most common, but up until this year. And now, most people aren't taking 5 year fixed rates today.
So you're seeing the sentiment of the people you're working with think that rates aren't going to stay this high that long, so they don't want to lock in for that whole period.
Yeah,
They might come back down.
Yeah, in a sort of micro way of thinking in that sense. Yeah, I mean the overall perception is that look, we're doing this for a reason, right? The rapid pace of increasing interest rates is to try to cool not only our housing market but to try to control inflation. We're at rates that we see right on the forefront. We see how this is affecting the market. We see how this is affecting our office, specifically mortgage brokers, lawyers' offices, realtors out there. Like when the rates go up this quick, this violently, business comes to a halt immediately for us. Like there's still deals being done, don't get me wrong, but it's just a lot slower. We see it right away. Now this takes time to sort of hit the other elements of the market. So how do you tie rising interest rates to trying to control inflation? How does that tie together? Well, if you increase people's overall debt, then you'll try to curb spending, and that's what we're trying to do to slow inflation. We're trying to curb spending. So if people have higher costs on their mortgage, higher monthly payments, they may not be going out for the dinners. They may not be going out doing the renovations, amongst other things. They may not be spending extra money going to the movies or things like that. So things like this could push us towards, the R word, which, the recession is what people think. Mm-hmm. And the long-term strategy on something like that, what people might believe is if we get to that point, then the only way to promote spending and get consumers out there spending again would be to lower interest rates, right? You try to control inflation by raising interest rates. And if you want to promote spending, what better than to lower the cost of borrowing money?
If the market was just doing what it naturally would on its own terms without a central bank setting rates, what do you think would happen?
Oh, man. I don't know if I have the complexity to... inflation is normal. right? Like inflation should be around 2%. That's where they're trying to get it at. Inflation is normal, but it's like, you know, you have to look at what led us to this, right? Like, why are we here? Why? I mean, there's many reasons. There's not one, but you could point to, you know, the start of COVID as being one of the, you know, one of the moments in time where we did everything we could, right? I don't mean to be critical of the government at all, because I say this before, it's sort of a phrase that makes a lot of sense at the time. You know, it's hard to judge the doctor on the battlefield, right? It's hard to gauge the triage in the middle of the battle.
Sure.
So we did what we thought we had to do, right? We thought we were headed towards a recession. We thought people were going to lose their jobs, and we tried to inject some money and lower interest rates and to get us out of that. Now, what we didn't think is that would lead to a massive, you know, push of real estate. I mean, that people sitting at home, one of the things that happened in real estate specifically is it went digital. You know, the days of people going to a house, looking at it 2-3 times before they put an offer in, like that stopped happening. You know, people were lucky to go once. There was a time where you couldn't even go see the house for a little bit because appraisers couldn't get in, COVID, this and that. So it became more digital. And when it became more digital, it became a little bit easier for people. You know, the realtors could do the meetings. You don't have to come into my office. The mortgage brokers, I could give you the pre-approval. Just give me your documents. We'll meet on Zoom. It just became easier. You don't have to go and sit with people anymore. You combine that with low interest rates, you know, easier to qualify at the time. You know, mortgage payments were low if you were on a variable rate. You know, qualifying rate was lower. All these things, you know, people sitting at home looking for ways to, you know, spend the money, the equity that they've built from the previous decisions that maybe pushed our real estate market up. But inevitably, it caused a massive amount of, you know, supply and demand issues. And the housing market went bananas, and in turn spending went up and inflation has gone up. So now we have to make decisions that, you know, are based on some of the decisions we made earlier, and that's led us to today. So hard to answer that question.
Sure,
I don't
yeah.
mean to drag on, you know, but it's like we made decisions that we always do. I mean, cause and effect.
Yeah.
Right? You make a decision and we live with it and we see the effect of it years later. And that's what we're seeing now. So we'll see the effect of the decisions they're making this year, not until, you know, maybe end of next year, middle of next year, maybe 2024. It's going to take time for for the violent and fast nature at which the rates have gone up will take time to establish itself in the economy. Because most people at this point, as we sit here in October, rates started to go up in March. Most people have only seen, you know, a few months of mortgage payment increases.
Yeah.
So it's going to take time.
You made a really interesting point there about the digitalization of real estate investing. It almost made me think of how, like, instead of going to Walmart, everything's gone online, and you can just shop through Amazon for anything that you need. And it's made consumer spending so much easier with online stuff. But now people, I didn't think about that, but people are shopping for real estate in the same online fashion, making it just easier, like reducing those barriers to entry.
Yeah.
You know, if you've got a tight schedule, just getting across the city to meet with your real estate agent or to go walk through some investment properties, you know, that can be too much for someone who's got a really tight schedule, which could literally prevent you from buying a home.
Yeah, the old way of doing things was the realtor would pick you up on a Saturday maybe, and they'd have 5 or 6 houses ready to go, and you'd spend the day driving to the different houses and walking through. Now you can eliminate a lot of that with the visuals, the walkthroughs, virtual tours, things like that. Not to say you don't want to go out there and see the properties. Most people do before they put the offer in. But imagine how much you can cut out. You can cut out some of the visits with properties. You know, it's easier, especially for a mortgage. I mean, the days of people going into the bank, you know, hey, I have a meeting with my bank next week to get my pre-approval numbers. Well, that just seems so
archaic.
Right?
Yeah.
And here we are, 2022. Nowadays, it's like, let's jump on the phone. Let's jump in a Zoom chat. You know, give me your numbers. Send me your documents. I can have this done much quicker. You don't have to
It's so much more
drive.
frictionless.
Yeah, much easier. So that's one of the, you know, our office specifically, we went from, you know, office space, physical office space with all of our staff to everybody working from home. And now that, you know, everybody's back to work, everybody's staying at home for us. It's just more efficient. It's more effective. The staff driving to work nowadays just seems like a waste of time.
Yeah.
45 minutes in the car before you get to work. Most people at my office, God bless them, they'd rather work.
Sure.
You
Yeah.
know?
So what are do you have any inside information that you can share, like just being in the mortgage industry, dealing with banks? Is there any like insider info or insights or rumblings or rumors about what's coming down the pipe?
Yeah, I mean, I read, you know, I think about as much as anybody who has not a good knowledge. I wouldn't say I have a great knowledge of where, you know, the economic understanding, but I have a good one. But my strength is I read people who do. So, I read CIBC. I follow their economist, Benjamin Tal. He came out with an article today that said, this is an indication potentially that rates are going to stop going up. Not that they will in the short term. I don't want to say that, because I think we're set for probably another increase or two, right? We don't know how much, but he indicated that this at least is a measure that shows that, we may be coming to the end of that rate spike. So insider info, I wish there was meetings with the RBC, CIBC, Scotia, and I got to sit at that table and listen to what people were saying. But unfortunately, I Google and I read news. I go to various sources, I listen to Dave. Dave's a smart guy. I listen to Dave Butler, for those that know Dave Butler.
Sure. So. Okay. Anything else on rates that investors, homeowners, anyone looking to buy, refinance, anything that anybody should know right now?
No, just, interest rate, is an important part of the equation. Lowest interest rate isn't always the best fit for people, right? You don't want to necessarily sacrifice the lowest rate for options. So what I would say, now listen, lowest rate is oftentimes the best rate. So don't get me wrong, but I think it's an important time to have a conversation when you're closing a mortgage. Talk to your bank, talk to your mortgage broker, whoever it is. You have to have a conversation, because this decision isn't just about monthly payments. This decision should be about planning. Where do I see myself? Do I plan on selling this house? Do I want to keep this house? Like there's a conversation to have.
Mm-hmm. Okay. So just open, honest conversations with the professionals.
Open, honest conversations.
Yeah. Sounds like relationship counseling. Now.
That's it, man.
Yeah. Okay, cool. Thanks, Dan.
You got it.